Advanced corporate accounting. Liquidation or winding up is a process by which a company is dissolved and its assets realized and applied in paying of the liabilities of the company. If there is any surplus after closing of the liabilities, it is distributed to its contributors according to their rights. Poor preferential creditor. A preferred creditor, also known as preferential creditor, is an individual or organization that has priority in being paid the money it is owed if the debtor declares bankruptcy. What is liquidation of company? Liquidation is a process in which a company is brought to an end. What is compulsory winding up? A company can be legally forced to wind up by court order. What is liquidation? A secured creditor, any creditor or lender associated with an issuance of credit product that is backed by collateral. List to be attached to the statement of affairs. List A, a complete list of assets not specifically pledged. List B, a list of assets which are specifically pledged in your favor is fully secured and partly secured creditors. List C, a list of preferential creditors. List D, a list of debenture holders and other creditors. List E, a list of containing the names and address and occupation of unsecured creditor and the amount due. List F, a list of containing name and number and the value of shares held by various preferred shareholders. Order of payment, liquidation expenses, liquidator remuneration, secured creditor, debenture holder, preferential creditor, unsecured creditor, preferred shareholders, equity shareholders. Format of liquidator, final statement, receipts, payments, receipts, two types, book value, realized value. Asset realized, fixed asset, current asset, stock, plant and machinery, land and building, debtors, cash, furniture and fittings, surplus, secured and securities realized from secured creditors, two calls in arrear, payments, legal charges, liquidator remuneration, three types, asset realized, preferential creditor, other unsecured creditors. By liquidation expenses, preferential creditors, debenture, interest and debenture, other unsecured creditors. Problem. The following particulars relate to A Limited, a company which went into voluntary liquidation. Preferential creditor 25,000, unsecured 58,000, debenture 30,000, asset realized 80,000, expenses 1,500, and the liquidator remuneration was agreed to 2.5% on the amount realized and 2% amount paid to unsecured creditors, including preferential creditor. Calculate the liquidator final statement. Receipts, asset realized 80,000. Legal charges nil balance. Remuneration 3 types. 2% of asset realized, 2.5% of unsecured creditors. Asset realized 2,000. Preferential creditor 2,500. Unsecured 25,588 into 2% 412. Total liquidation remuneration 2,902. Expenses 1,500. Preferential creditors 25,000. Debenture 30,000. Asset realized 80,000. Balance 20,588. Balance amount transferred to unsecured creditors. Amalgamation. When two or more companies go into liquidation and a new company is formed to take over the business, and the about two or more companies, it is said to be amalgamation to avoid competition and to fix the price of article. Amalgamation take places. Absorption, when one or more existing companies into liquidation and some existing company take over the business, it is said to be absorption. That is the business of small company is absorbed by the big company. Difference between internal reconstruction and external reconstruction. Internal reconstruction, 4 types of difference. First one is the company does not identify. External reconstruction, the company lost its identify. Internal reconstruction, the overvalue asset are revalued at the net worth and the loss written out. External reconstruction, the newly formed company take over the asset and the liability, the liquidated company at agreed value. Point number 3, internal reconstruction. No new companies is formed, nor is any existing company liquidated. It is the internal matter of single company. A new company is formed in a place of old company. Debenture holder, creditors and bank overdraft may continue the internal reconstruction. External reconstruction, the last one, this party will have been settled. Reconstruction. Reconstruction refers to the reconstruction of a company financial structure. It may take places with or without liquidation of the company. A company goes into voluntary liquidation for reconstruction, then it is known as external reconstruction. If a company does not go into liquidation, then it is known as internal reconstruction. Lump sum method, strictly speaking, this is not method where the purchase consideration amount is mentioned in the agreement directly. It is called lump sum method. And purchase consideration, this method does not involve calculation regarding the purchase consideration. Net payment method. Under this method, the purchase consideration will be the total payment made in any form by purchase company to vendor company on any basis. Generally, purchasing company decide the payment to be made towards liability of vendor company, not taken over and towards the expenses. The total such payment will be the purchase consideration. Net asset method. Under this method, purchase consideration will be the excess value of asset taken over by the purchasing company over value of liabilities taken over, that is under this method. The purchase consideration will be calculated using the formula purchase consideration assets taken over the value minus liabilities taken over the value of liabilities, that is called net asset method. Intrinsic value method. Under this method, the purchase consideration ascertained on the basis of relation in which shares of purchasing company are exchanged with those of the selling company. The exchange ratio is generally determined on the basis of intrinsic value of the respective company shares. Difference between amalgamation, absorption. 5 difference between amalgamation and absorption. Amalgamation, 2 or more companies carrying on similar business merged in one single company. Absorption, on existing takeover the business one or more existing companies. Amalgamation, all amalgamation companies should go into liquidation. The companies whose business are taken over should go into liquidation. Amalgamation, a new company is to be formed to take over this liable business. No new formation of company which is necessary. The purpose of amalgamation to bring out the combination or for eliminating the companies. The purpose of absorption is to the purchase, other business expanding to the activities or size of the business. The central government empower to order of the amalgamation two or more companies in the national interest. Absorption company, national interest is not possible under this act. The difference between amalgamation and absorption. Meaning internal reconstruction. Internal reconstruction, when one company changes how it's owned and run, it does not become a new company or shut down completely. The company might want to be change how much ownership. Each shareholder has reduced the amount of money they owe to the others. Internal reconstruction. Internal reconstruction refers to the internal reorganization and the re-financial structure of company. It is also termed as organization which permit the existing companies. It is continued. Generally, share capital reduced to the past accumulated losses of the company. Problem: X Limited to upgrade the required assets excluding cash on 31st December 2000. Y Limited balance sheet of Y Limited unlisted. Balance sheet total 5 lakhs. The consideration as follows: cash payment 4 rupees for every shares of Y Limited. The issue of shares 10 each. The market value 12.5 rupees of X company. The every shares in Y Limited. The issue of debenture 50 each. X Limited. Enabled to Y Limited discharge of debenture premium 10%. The expenses of liquidation Y Limited amounted to rupees 4,000 that to be met themselves in the journal entries and journal entries. The both companies, X company and Y Limited. Journal entries. Realization. The realization of all the assets. Take over the goodwill, land and building, land and machinery, stock. Goodwill value 60,000. Land and building 1,20,000, land and machinery 2 lakhs, stock 80,000, debtors 30,000. Asset transfer to realization 4,90,000. Creditor transfer to realization. Creditors account debtor to realization 10,000. Debenture transfer to debenture holder. Debenture account 50,000. Realization 5,000. Transfer to debenture holder 55,000. X company purchasing. X company limited account debtor to realization 4,75,000. Bank share transfer to purchasing company. Bank account debtor 1,20,000. Share account debtor 3 lakhs. Debenture account debtor 55,000. Transfer to X Limited 4,75,000. Bank account transfer to realization. Realization account debtor to bank 4,10,000. Accumulated profit and loss transfer to shareholders. Realization share capital account debtor, general reserve account debtor to shareholders. Share capital 3 lakhs, general reserve 60,000, profit and loss 80,000, total of 4,40,000. Shareholder account transfer to realization. Shareholder account debtor to realization 2,40,000. Shareholders share bank transfer to shareholder. Share account debtor 3 lakhs. Bank account debtor 1,60,000. Transfer to shareholders 4,16,000. Debenture transfer to debenture holder. Debenture holder account debtor to debenture 55,000. Realization to cash. Cash amount 4,000. Internal reconstruction. Difference between internal and external reconstruction. 3 types of differences: basis, new company, capital reduction. Meaning this method corporate restricting wherein existing company is not liquidated a form of new one. External reconstruction. External reconstruction is one which the company undergoing reconstruction is liquidated to take over the business. Existing company, new company, no new company is formed. New company is formed. Capital reduction, capital is reduced and the external liability holder pay their clients. No reduction in the capital. The following liabilities of asset, the Pharma Limited on 31st March 2015. Liabilities, asset, equity share rupees 10 each, 5 lakhs, preference share of rupees 100 each, 7,50,000. Creditors, land and machinery, patent, stock, debtors, P&L. The company suffered loss and the following scheme of adopted. Equity share reduced 25 each, preference share reduced 50 each. The amount available used right of 39,240. The plant and machinery 15,000. The make a provision 15,300. Doubtful debts. The balance used of right of patents. Calculate the journal entries. Internal reconstruction. 3 journal entries of internal reconstruction. First one is for reduction of equity shareholder, equity share capital account enter, 2 equity share capital, 2 capital reduction, equity share capital account enter, 100 book value, 5 lakhs, 2 equity share capital reduced by 25, 1,25,000, 5 lakhs minus 1,25,000, capital reduction transfer to 3,75,000. Preference share capital account enter, 2 preference share capital, 2 capital reduction, preference share capital book value 100, 7,50,000, reduced by 50 rupees, preference share capital 3,75,000, balance 3,75,000, capital reduction transfer, capital reduction, equity share capital 3,75,000 plus preference share capital 3,75,000, totally 7,50,000. Capital reduction transfer to accumulated profit and losses, goodwill, patents, profit and loss of the asset, depreciation of asset. The first one is plant P&L 1,45,000 book value, plant and machinery reduced 39,240, stock in trade reduced 15,000, provisions for doubtful debts reduced to 15,300. Total capital reduction 7,50,000. Accumulated losses paid, remaining balance, patents, balancing figure 53,000, 5,54,060. The balance sheet of internal reconstruction, share capital 50,000, creditors 50,000, assets 1,33,760, 3,14,540. Total 5,50,000. The revised balance sheet of internal reconstruction. Meaning of insurance. Insurance is a contract whereby the insured agreed to companies for a specific loss. The insured, who is consideration agreed to pay regularly as a sum of money, is called premium. The insurance company is known as the insurer and the person taking the policy from the insurance company is known as insured. Therefore, insurance is a commercialized the form of spreading risk. Kinds of insurance. 2 types: life insurance, general insurance, fire insurance, marine insurance. Life insurance, it is contract between the insured and the insurance company in which the insurance company agreed to pay the policy amount on death or insured. The maturity of policy in whichever is earlier for the purpose of insured agreed to regularly remit a certain sum of money, premium, example, whole life, endowment, health and educational. General insurance, all insurance contract other than life insurance are known as general insurance. Example, fire insurance, marine insurance, liability insurance, motor, debt liability, accident insurance. Holding company. A holding company that hold either the whole of the share capital, majority of shares, one or more companies, so as to have controlling the interest. Such company as the companies known as subsidiary companies. Subsidiary company. Section 287, the Companies Act 2013 define a company. As per the section, company shall be deemed to be subsidiary company of another. If the other company control the composition of its board of directors, when the first mentioned company, another company hold the more than half its nominal value of its equity share capital, or the company subsidiary of any company which is that other company's subsidiary. A subsidiary company may be either fully owned subsidiary or partly owned by subsidiary. Minority interest. When some of the shares the subsidiary company are held by the outsider other than holding company, their interest in the subsidiary company is called minority interest in its subsidiary company. Cost of control or goodwill or capital reserve. The company holding company purchase the share of the subsidiary company is at a price more than paid up value. The excess of cost of control or goodwill. Minority interest. The claim of outside shareholders in the subsidiary company has to be assessed and shown the liability in the consolidated balance sheet. Minority interest in the net asset of the company is nothing but the proportionate share, aggregation on share capital, reserve and surplus, funds, etc. The proportionate share, all assets should be deducted from the minority interest. Problem. Balance sheet of 31st March 2009. Liabilities, share capital, reserve, creditors, asset, sundry asset, 100% of shares, preliminary expenses. Share capital 1 lakh, purchasing company, holding other, that is holding company, 100% of shares. Ratio nil. Revenue profit on the date of balance sheet, revenue profit nil balance, capital profit reserve minus preliminary expenses minus cost of control or goodwill. Purchasing face value 1,70,000, face value 1 lakh, capital profit 22,000, balance 1,22,000. Minority interest nil balance, that is ratio nil balance, minority interest nil balance. Revised consolidated balance sheet. Share capital 2,50,000, reserve 50,000, creditors holding company, subsidiary company totally 70,000, reserve 5,000. Asset, sundry asset, holding company, subsidiary company totally 3,75,000. Balance sheet total liabilities asset 3,75,000. Banking definition. Banking means accepting for the purpose of lending, investment or deposit of money for the public, repayable or demand or otherwise, and the withdraw by check, draft, order or otherwise. Non-performing asset. A non-performing asset is a loan or advance for which the principal or interest payment remain overdue for a period for 90 days. Write a short note on net asset method. It is the sum of total of everything your company owns cross asset minus the total cost of your debts, liabilities. Give a short note on rebate and bill discounted. A rebate and bill discounted, discount received but discount received in advance, unexpired discount, discount received but not earnings. What is non-banking asset? Non-banking asset therefore are those financial assets acquired by the bank, settled their debts. Profit and loss format. Two types of profit and loss: income and expenditure. Net profit, appropriation. Income, two types: interest and other income. Schedule number 13, interest and schedule number 14, other income. Expenditure, two types: interest expended, schedule number 15, operating expenses, schedule number 16. Net profit, income minus expenditure. Appropriation, profit transfer to 25% statutory reserve. Interest earned, interest on loan, interest on overdraft, interest on cash credit, interest on current account, amount charged against current account, opening rebate on bill discounted, closing rebate on bill discounted. Schedule number 14, other income, commission, locker rent, transfer fees, exchange, profit on sale of asset. Schedule number 15, interest expended, interest on current account, interest on fixed deposit, interest on savings account. Schedule number 16, operating expenses. P&L account debit side all expenses to operating expenses. For example, rent, telephone charges, advertisement, depreciation, printing and stationery, insurance, income tax, etc. The format of balance sheet: banking, liabilities, asset, capital, liability side, capital, reserve, deposit, borrowings, other liabilities of provisions. 5 schedules. Schedule number 1, share capital. Schedule number 2, reserve. Schedule number 3, deposit. Schedule number 4, borrowing. Schedule number 5, other liabilities, assets. Schedule number 6, cash. Schedule number 7, money at cost or notice. Schedule number 8, investment. Schedule number 9, advances. Schedule number 10, fixed assets. Schedule number 11, other assets. Schedule number 12, contingency liabilities. On 31st March 2020, bank had the following bills discounted by its earlier date of bills: 17, February 7, March 9. Date of bills 4 months, 3 months, 3 months. Discount 10%, 9%, 11%. Amount 5,30,000, 6,40,000, 2,80,000. You are required to prepare bills discounted. Closing date of bank 31st March 2020. Date of bills January 4, 4 months. Closing date after the 4 months: February, March, April, May. February 7, the date of bills March 20, closing date 3 months: March, February, after February, March, April, May. March 9, closing date 31st March 2020, 3 months: after March, April, May, June.